What's up, Squares? Harold Perkins here to answer another round of your mortgage questions. These questions come to us from people either preparing to apply for a mortgage or want to double check the information they're getting from their mortgage broker. As always, we're here to help, so you can ask your questions in the comments below or message me on any of my socials. Best question of the week gets answered right here. Let's get to it. The first question comes from Sam. He asks if a lender can pre-approve without pulling credit. If multiple lenders pull credit multiple times, is the deemed to the credit bad? Good question, Sam. But first, there are two things to address in your question. There is a difference between pre-approval and pre-qualification. A pre-approval will require a credit report because it means that an underwriter has reviewed all of your documents as well as your credit in order to give you a loan approval. There is much more to a credit report than just the credit score, so it's necessary to review the credit report in order to issue a valid loan approval. A pre-qualification can be done without a credit report, but you shouldn't. A pre-qualification is usually done by the loan originator and not the underwriter. It's only meant to tell you that based on the information that you provided as the borrower, that you meet the guidelines for the loan program that you applied. But in a pre-qualification, the information that you provided has not been verified. Once everything's been independently verified by the underwriter, then you're pre-approved. Sam, I understand your concern with having multiple lenders pull your credit, but this is actually okay and does not hurt you. The credit scoring system actually encourages you to shop for your mortgage. Any credit inquiry for the same type of credit that occurs within a 14-day period of time is actually treated just as one inquiry by the scoring system. Yeah, that's right. You can have 10 different mortgage companies pull your credit, but it doesn't ding your score because the scoring system only counts it as one. For the last part of your question, most lenders will be willing to quote you an interest rate based on the credit score that you state to them if you prefer to not have your credit pulled. But I would also tell you that when we do pull your credit, if the score is different than what you stated, then my quote would no longer be valid. But if you watch my video on how to pick your mortgage broker, it will show you that you do not need to get quotes from several different lenders. Check it out. Bonus question to piggyback on Sam's. Can you get a mortgage if you've had a lot of recent inquiries? The answer is yes. I assume this question to mean that it's a lot of inquiries separate from shopping for a mortgage. Maybe it was also for credit cards or auto loans or whatever. The only thing that happens here is that you'll be asked to write a letter that states whether or not any of the credit inquiries have resulted in any new debt. If so, then those debts will have to be counted against your qualifying. The next question is from Kevin, and he writes, our lender is asking for our 2021 tax transcripts. The problem is the IRS has not processed our tax returns even though we filed them in May. Is there a suitable substitute? Kevin, the IRS is a mess right now. At the end of May, the IRS had 21.3 million unprocessed tax returns. This includes almost 9 million that are still not processed from filing the year before. So what I'm saying here is, you're not getting your transcripts anytime soon. For those of you who don't know, the transcripts are the record of your tax returns that the IRS has on file. The reason sometimes lenders ask for transcripts is they want to make sure that the copy of the tax returns that you provided to the lender are the same as what you filed with the IRS. The idea being that they find out if you gave the lender fake tax returns in order to show more income to qualify. Obviously, no one would ever do that. So what do? Well, there's a couple of options. So while the IRS is very slow to process your tax returns, they are very quick to cash your check if you owed any taxes. If you provide proof of payment of any taxes owed and the amount of the payment matches what you owed on your tax returns, then most lenders will accept this as proof that the tax returns you provided are the same as what you filed with the IRS. Or maybe you're getting a refund. In that case, you can go to irs.gov/refunds to track your refund. Printing these results from the IRS website can also be used as proof of the validity of your tax returns. Two awesome questions so far. Thank you very much. If this information helps you, or if you know someone that's had issues with their mortgage application, please make sure to hit the like button so more people can get help from videos like this one. Also, please make sure to stay to the end of the video so that you can see the question of the week. Next up is a question about gift funds. It reads, I'm buying a house with an FHA loan and have gotten a gift from my grandma and my dad. The problem is the lender is requesting their bank statements. My grandma and dad are very old school and do not want to release their information. I just don't know what to do. Well, this is a tough one because it is true on FHA loans, it is necessary to document the transfer of gift funds from the donor to the recipient. FHA is very strict about making sure that the deposit into your bank account matches exactly with the withdrawal from your grandma and your dad's bank accounts. Unfortunately, with FHA, there is no workaround, and it's a conversation that I've had with many parents and grandparents just like yours. Sometimes what helps is to explain why FHA is so strict about this. So the reason the bank statement from the donor is a guideline with FHA is that they want to be certain that the money truly is a gift and not a loan. If the money were a loan, then there would be repayment terms for that loan. Those payments would then affect your debt to income ratio and possibly affect your ability to repay the loan. Well, that makes sense, so why so strict about the bank statement? That's to prevent somebody from taking a loan of some kind for the down payment, but then just having their grandma or their dad sign a gift letter saying that they gave you the money. Obviously, no one's ever done that. And then I would talk to your grandma and dad about the legal obligation that all financial institutions have in keeping their personal information secure. We are all regulated to comply with the Gramm-Leach-Bliley Act, which requires us to safeguard a client's private information. And every state regularly audits every financial institution to verify their compliance with the rules and regulations. Their information is safe. And now it's time for our question of the week. This one came from Reddit and goes, I know the Fed just increased rates by 0.75%. How long will that take to impact mortgage rates? Any idea how much mortgage rates will go up with that hike? This is a great question, and we get this whenever the Fed does anything with interest rates. First things first, the Fed rate and mortgage rates are completely different things. The Fed rate is what banks charge each other to borrow money from each other overnight. It is not a rate that's charged to consumers directly. But the Fed rate does influence mortgage rates. The reality of it, though, is that the recent rate increase by the Fed was already built into mortgage rates. So leading up to July 27th, we saw mortgage rates increase steadily. But here's the interesting thing. Since the Fed announced the rate increase, mortgage rates have actually declined. This is because the market reacts positively when the Fed does what's expected, even when what's expected is not necessarily good news. So what happened was mortgage rates increased ahead of the Fed increase by more than what would be normal for a 0.75% increase in the Fed rate. Then when the Fed confirmed the 0.75% increase, mortgage rates pulled back to correct. So never panic lock in your interest rate if you hear the Fed is going to raise rates that day. It's already built into the mortgage rates. And chances are mortgage rates will be lower the next day if the Fed does exactly what's expected. Make sure you ask me any of your questions in the comments below or message me on any of my socials, and who knows, you could end up having the question of the week. And you can watch my other Q&A videos right here too. Later, nerds.